Women plus real estate. Real estate insight for decisive, intelligent women who learn, rent, own, invest, and live with intention. Here's what's happening this week. You hear this statistic all the time, right? To the point where it almost feels like background noise. Yeah, you really do. Women earn 82 cents for every dollar men earn. And usually when that number is brought up, it's framed as, a reason to feel perpetually behind. Like a reason to just wait until the playing field is somehow magically leveled before making any major financial moves.
Which is a very natural psychological reaction, honestly.
Totally. But then if you look at the current real estate data, it drops this absolute bombshell of a fact that shatters that entire narrative. Because right now in the United States, more single women own homes than single men. It's wild. It forces us to completely reevaluate our assumptions about how wealth is actually being generated in this economy today. We have this deep-seated economic model that assumes income directly dictates asset acquisition. Like if Group A makes less than Group B, Group A should obviously own fewer assets. Makes mathematical sense, right? Exactly. But the housing market is showing us a demographic that is actively subverting that mathematical expectation. Which is exactly why we are pulling apart the March 14th, 2026 edition of the Women Plus Real Estate Market Intelligence newsletter today. It is a fascinating read. It really is. The ground of the housing market is just moving under our feet right now, whether you're staring at a Zillow listing, trying to buy, debating if you should renew your lease, or just trying to figure out where the broader economy is heading. The rules are changing rapidly. Yeah, they really are. And the main mission of this review is to map out that landscape for you. Because the main takeaway from this newsletter is that the people winning in this environment, they're not waiting for perfect conditions. Okay, let's unpack this. Starting with that crazy demographic flip. Right, so that demographic reversal, single women outpacing single men in homeownership, it has actually been quietly building since the early 2000s.
Oh, wow, that long?
Yeah, it's not a sudden spike, but the newsletter emphasizes something crucial about the underlying mechanism here. This isn't some, statistical anomaly or a consolation prize for the wage gap. It is the result of a deliberate, highly calculated strategy by female buyers to just engineer their way into the market. I have to admit, that goes against almost all the traditional financial advice I grew up hearing. Oh, absolutely. The conventional wisdom is always, wait until you have equal footing. Wait until you get married and have that perfect dual income setup to tackle a massive mortgage. Well, because the traditional advice assumes a static environment. It assumes time is on your side. But consider what happens when a buyer decides they literally cannot wait for systemic pay equity to arrive. What's fascinating here is that the newsletter makes it clear these buyers are running the numbers and getting incredibly creative. Like how? Well, they're getting creative with their debt-to-income ratios. They are pooling resources for co-buying situations. They are targeting smaller footprints in emerging neighborhoods. And crucially, they are tapping into systemic blind spots. Blind spots? Yeah. For instance, the newsletter highlights their heavy utilization of platforms like downpaymentresource.com. Right, it aggregates state-level down payment assistance programs that the vast majority of traditional buyers don't even realize exist. Basically, they are substituting capital with actionable intelligence. Oh, I've heard of that. It reminds me of playing a board game like Monopoly, but you start the game knowing you're going to get less money every single time you pass go. That's a great way to look at it, right? If you play by the standard strategy, waiting and saving up to buy the premium squares like Boardwalk or Park Place, you are going to lose. You will simply be outscaled by the players making more money.
Exactly.
So, instead, you complain less about the rules and you completely abandon the traditional advice. You buy the cheaper properties like Baltic Avenue immediately the second you land on them. You put your foot on the board, you put a house on it, and you start building a compounding engine with whatever limited resources you have. That captures the dynamic perfectly. They are accepting a higher degree of difficulty upfront to secure a long-term compounding asset, which is so smart. It is. And looking at the broader market data we have today, that aggressive strategy-first mindset, looking at the data exactly as it is rather than how we might wish it were, that's the exact lens we need to apply to everything else we're talking about today. Which brings us perfectly to the rental market, because buying requires aggressive strategy right now, renting requires impeccable timing. Oh, completely. The newsletter polls from the February 2026 Apartment List National Rent Report, and the data is showing a very specific window that is about to slam shut for renters. Right, so the top line number from February is a month-over-month rent increase of 0.2%, and the national median monthly rent is now sitting at $1,357. Okay, wait, I am going to push back on that being a major signal because 0.2% is basically a rounding error, right? And furthermore, the source explicitly states that the National Vacancy Index just hit a record high of 7.4%. That's the highest since they started tracking it 9 years ago. Plus, year-over-year rents are still down 1.5%. We just had a historic construction boom that dumped over 600,000 new apartment units in 2024, and the average time it takes to lease an apartment right now is sitting at 40 days.
Oh, right. That's true. Yeah. Yep. So, with all that oversupply and all
These empty units, why should a renter care about a fraction of a percent increase in 1 month? Shouldn't renters just have all the power forever? I mean, on paper, looking backward, yes, but markets are forward-looking mechanisms. The nuance here is in the construction pipeline. Okay, explain that. That massive construction surge in 2024, it essentially broke the pipeline. Developers pulled back hard. In 2025, the market delivered fewer than 500,000 units, and the projections for 2026 are falling even lower. Yeah, so landlords and institutional property managers aren't pricing their units based on the glut of 2024 anymore. They're pricing them based on the incoming supply cliff of late 2026.
Oh, wow. So they're looking at the empty lot down the street, realizing literally no one
One is pouring concrete and adjusting their strategy today.
precisely. The psychology of the landlord has fundamentally shifted.
2 months ago, a property manager was looking at a 7.4% vacancy rate and offering, 2 months of free rent to get literally anyone in the door. Right, the crazy concessions. Exactly, but now they're moving from taking any tenant to waiting for the right tenant. Algorithmic pricing models are factoring in that slowing future supply, so that 0.2% bump isn't a rounding error. It's the first monthly increase since July of 2025. That's a big deal. It signifies that the seasonal clock has shifted. For 3 consecutive years, the data shows that March, not May, is now the peak month for rent growth. March is the new May. That is a massive shift in market behavior. And we are already seeing the endpoint of this absorption cycle in the Sun Belt. Look at Virginia Beach.
What's happening there?
The newsletter points out that Virginia Beach is leading the entire country right now with 5.3% annual rent growth.
Wait, really? 5.3%? Yeah.
Yes. Why? Because they already absorbed their localized share of that 2024 supply. The concessions there are gone. That 5.3% growth is a direct preview of what is coming to the rest of the country as the surplus gets swallowed up. So, if you are listening to this and you have a lease expiring anytime between now and September, the actionable takeaway is that the time to negotiate is Q1. You have to act now before the spring competition peaks. And while property managers still have some of that 2024 inventory hanging over their heads. Right, exactly. Because the underlying mechanics of the market favor the renter today, but the math flips entirely by Q3. Timing is the only leverage you have when the macro supply is shrinking. And interestingly, that exact same supply constraint is creating a very different psychological reaction on the home buying side. Here's where it gets really interesting. Let's pivot to that home buying data because the February numbers are genuinely surprising. Existing home sales jumped 1.7% month over month, hitting a seasonally adjusted annual rate of 4.09 million, which crushed expectations, by the way. Right? The market was only expecting 3.89 million. Everyone thought January was a slump, but it turns out that was just bad weather. And the most interesting detail to me, first-time buyers suddenly make up 34% of those transactions. Yeah, it's a big jump. How are completely sidelined first-time buyers suddenly affording homes when mortgage rates are still hovering over 6%? It comes down to the quiet accumulation of purchasing power over the last 12 months. The source highlights the National Association of Realtors Housing Affordability Index, which is guided by Dr. Lawrence Yun. The index just hit 117.6 in February. That is the highest affordability reading since March of 2022.
Okay, wow.
Yeah, it is the eighth consecutive improvement, and if we break down the concrete math, it explains why those first-time buyers are finally off the bench. Let's look at a median home priced at $398,000 with a 10% down payment. Okay, 398,000. Got it. Got it. A year ago, rates were sitting at 6.65%. Your monthly principal and interest on that house would have been $2,316. Today, the rate is 6.94%. That exact same house with that new rate costs $2,174 a month, which is a savings of $142 every single month. Exactly. That's over $1,700 a year staying in the buyer's pocket purely from the rate softening. But, I mean, $142 a month doesn't seem like quite enough to trigger a massive wave of buying on its own, right? It isn't, but that rate drop is colliding with wage data. Wage growth is now finally outpacing home price growth by nearly 4 percentage points. Yeah, so buyers have slightly lower borrowing costs combined with meaningfully higher relative incomes compared to 12 months ago. Oh, that makes sense. It feels like a massive psychological recalibration. Yeah, because back in 2020 and 2021, we had those 3% emergency pandemic rates. It was like sitting in a room with the thermostat cranked to 85 degrees. Very cozy, super cozy. Then the Fed hiked rates to 7 or 8% to fight inflation. Now, historically, an 8% mortgage is perfectly normal. I mean, it's the 50-year average. But to a market used to 3%, stepping into 8% felt like walking outside into a freezing blizzard. Clear coat, everyone just froze. Exactly. The transaction volume completely died. But now, rates have settled at 6.11%. Buyers have realized that 6% is essentially 70 degrees. It's the new room temperature. It's totally comfortable. They've taken off the winter coats, stopped waiting for 3% to return, and are just getting back to normal life. That's a great analogy. The blizzard shock has absolutely worn off. Consumers have accepted it. However, Dr. Yoon notes a massive caveat in the data here. While demand is thawing, the total transaction volume remains incredibly muted relative to the broader strength of the economy. Think about this. We have 6 million more jobs today than we did in 2019. Yet, we are seeing 1 million fewer home sales per year than we did back then. So the market is moving, but it's definitely not fully recovered. So millions of newly employed people with rising wages, have recalibrated to the new mortgage rates. But when they actually go to an open house, there's a line out the door and absolutely nothing else for sale in a 5-mile radius.
None at all.
Right, it all comes down to a historic lack of supply. And that supply bottleneck is so severe that it's actually forced Washington to intervene, which brings us to the legislation. Yeah, this is a huge development. And real quick, I want to explicitly state to you listening that the source material touches on political figures and pending legislation from both sides of the aisle. We are not endorsing the viewpoints of this content, nor are we taking any political sides here. Our goal is simply to impartially report the ideas and legislative movements contained in our source material. So, looking purely at the data, the Senate just passed the 21st Century Road to Housing Act. Right, absolutely. The newsletter notes it passed with a massive 89-10 vote, which is rare. Very rare. Co-sponsored by Republican Tim Scott and Democrat Elizabeth Warren. Yeah, the mechanics of the bill aimed to attack the supply issue. It attempts to incentivize local zoning reform to allow denser building, and it modernizes regulations around manufactured housing. But it also contains a highly aggressive restriction on demand, a federal ban on large institutional investors acquiring single-family homes. Entities that own 350 or more homes would be entirely banned from purchasing more, and they would face a 15-year sunset provision to offload their current inventory. Okay, wait, let's think about the actual mechanism of that ban. I understand the populist appeal of stopping a giant Wall Street fund from outbidding a regular family for a starter home, but the source material also brings up build-to-rent communities. These institutional investors are very often the entities deploying the hundreds of millions of dollars in capital required to build entirely new rental subdivisions from scratch. So, can we actually solve a supply crisis while actively kicking out the biggest buyers who build new rental communities? Sure, you've isolated the core tension of the entire bill. If we connect this to the bigger picture, industry groups are warning that a specific provision in this legislation, a 7-year disposition requirement on build-to-rent properties, will structurally break the financial model of real estate development. Because they wouldn't be able to hold them long enough to make money? Exactly. Build-to-rent projects rely on 20 to 30-year yield models to justify the massive upfront costs. If the federal government mandates that developers must sell those properties within 7 years, the math no longer works. The capital will simply flee to other asset classes. So it could effectively shut down BTR development entirely, which ultimately harms renters. It's a fascinating paradox, and realistically, what are the odds of this fundamentally altering the market anytime soon?
Well, the source notes the future of the bill is highly uncertain. It still has to clear the House, and President Trump has already signaled he
He won't sign other legislation until a completely separate, unrelated voting bill. So it's basically tangled in severe gridlock, which leaves us with the people who are not waiting on Washington, the people who already hold the deeds. Yep. So what does this all mean for home equity? Because the numbers in the newsletter are creating some really terrifying headlines. They really are. The data shows that U.S. borrower equity dropped by $78.8 billion. On an individual level, the average homeowner supposedly lost about $8,500. Right, and when you see a headline screaming, homeowners lose $78 billion, it induces absolute panic. But looking at the actual context in the source, the average homeowner with a mortgage still retains $295,000 in equity. It's like panicking over
dropping a $20 bill on the sidewalk when you still have $3,000 safely zipped up in your pocket.
Exactly. That is the perfect way to frame it. This is a normalization of wealth, not an erosion. 44.6% of all mortgaged properties in the U.S. are still classified as equity rich. Which means what exactly? It means the loan balance is 50% or less of the home's estimated market value. Now, negative equity did tick up slightly, but the mechanism driving this is highly localized. It is heavily concentrated in markets like Austin, Texas, the pandemic boom towns. Right, areas that experienced explosive, fundamentally unsustainable price spikes. The local incomes could not support the housing valuations, and now those specific markets are corrected. But overall, people are just sitting on this historically unusual mountain of wealth, which naturally leads to the ultimate question: how do we actually track where that wealth is going next? Traditional economic models are constantly lagging behind reality. And this may be the most paradigm-shifting insight in the entire newsletter: the rise of prediction markets in real estate forecasting.
Yes, I love this tidbit.
The source notes that prediction markets accurately called the U.S. median home value within a 98.5% probability window for 2 consecutive months. It's incredible. They got it exactly right, while the massive institutional models from traditional banks were months behind the curve. For someone unfamiliar, how is a crowd-sourced platform beating Wall Street economists at their own game? It comes down to the speed of data processing. Traditional institutional models are rigid. They rely on historical data sets that take weeks or months to compile and publish. Prediction market, on the other hand, is a live exchange where independent traders place actual financial bets on future outcomes. So they're adapting in real time. Exactly. They're aggregating millions of fragmented real-time data points, a slight change in local lumber prices, a rumor about a zoning law, and pricing it into the market instantaneously. And because there's real money on the line, the market ruthlessly punishes bad data. So what are they saying right now? Well, looking at the current data for the upcoming April 1st report, traders are actively hedging. They've placed a 30% probability on the national median landing somewhere between $420,000 and $422,500.
Oh, wow. So they're pricing in the slight bump in mortgage rates, the soft labor data, the gridlock in Washington, all of it?
Right. And the newsletter notes that these crowdsourced prediction markets might actually become the new gold standard for understanding where your largest asset is heading, which really ties all the threads together. The dominant theme across all these sources is timing. Absolutely. Whether it's single women securing long-term wealth by executing creative buying strategies before pay equity is achieved, or renters who realize the seasonal clock has shifted and negotiating in Q1, or buyers capitalizing on the 6.11% rate recalibration, the market consistently rewards those who act on current data rather than waiting for perfect conditions to routine.
Right. Timing and execution over passive observation. But tracing that back to our very first point, this raises an important question about the physical future of our country.
What do you mean?
Well, if single women continue to systematically outpace single men in homeownership year after year, cycle after cycle, how will the physical landscape of our future neighborhoods fundamentally change?
Oh, that is a profound angle, right?
For almost a century, American housing
Development, suburban sprawl, the layout of cul-de-sacs, it was all explicitly designed and marketed around the traditional nuclear family model. Right, the classic four-bedroom suburban island. Exactly. But if the primary economic driver of new homeownership permanently shifts to single women, the developers will eventually follow the money. Will we see a complete revolution in how communities are designed and built, moving away from the traditional model to cater specifically to the preferences, safety, and community needs of single female homeowners? When you change who holds the economic power to buy the deeds, you eventually redraw the entire map. It is an incredible thought to leave you with as you watch the market shift in your own neighborhood. That's this week from Women Plus Real Estate. Full newsletter with data, links, and archives at read.womenplusrealestate.com. Until next week, keep your eyes on the market.